Hello students and welcome to the lecture. So students, as we know that we are covering the financial system, and basically what we are doing, we are doing the discussion over the Indian banking system, right? So basically these are the topics which we are required and which we are supposed to cover in this particular series of the Indian banking system. Like we are required to start with the generations of the banking. Okay. Thereafter, we are required to discuss the banking sector development 2014 onwards, and we had successfully completed the both the topics. Okay, which means now we are only left with the risk in the banking. Okay, this is the only topic left for us. Okay, and if we talk about the risk in the banking, basically we had started the discussion over it, and in the previous lecture basically we were seeing the stock market risk to the retail exposures. All right, and we have left the topic at the diversification. Okay, so if you haven't watched the previous lecture, or you can say if you haven't revised the previous lecture, then this lecture might be difficult for you to understand. Okay, because you have to understand that this is an continuation process. Okay, like we had started the risk of stock market volatility in the previous lecture. We had discussed like how the shares and the stock works. Okay, what are the different perspectives and the prospectors on that particular series. All right, and now we are going to take the decision which we had left in the previous lecture from now onwards and continue to the further. All right, so if you haven't watched or if you haven't revised the previous one, so might be you're not able to connect the things with the things we had discussed in the previous. Okay, so here is the term diversification. Okay, so let's see what does it mean by. Retail investors should diversify their investments portfolios across assets classes to reduce exposures to the stock market volatility. This can help mitigate the impact of a downturn in any particular sector or a market segment. Okay, so basically when we talk about the stock market, okay, when we talk about the stock market, or you can say when we talk about the share market, right? So in this area, basically what we have seen so far, we have seen that there might be condition of overvaluation, or you can say bullish condition. Okay, and this situation is dangerous for the bank or for the investors. Why? Because this creates an illusion which we call as an illusion of wealth, right? Illusion of wealth. And regarding the illusion of wealth, we had already seen in the previous lecture, like what do we mean by it. All right, so basically to protect this thing, and there is a very famous saying in the stock market, and the saying is never put your eggs or your all eggs in single bucket. Okay, never put your all eggs in the single bucket. It's a very famous saying in the stock market. Okay, so here basically egg is an investment. Egg signifies the investment and bucket signifies the shares. It is the investment, it is the shares. Got it? So basically it means that suppose if there are 4 companies A, B, C and D. Okay, there are 4 companies. Okay, and if this is an investors, all right, so basically it is required to ensure that this fellow person or this fellow basically must not invest all of his money into the single bucket. Okay, it means that all of the investment must not be flow in the one single share, or you can say here it has diversified the portfolio or the investment. Okay, now if that will be the situation, like this person and the four companies A, B, C and D. So if he would invested the entire amount in only one company, so there are chances that might be the A is not performed as it was expected. Okay, might be the ratio P to E. Okay, now what do you mean by the P to E? 10 seconds you have to think and answer. Your time starts now. It's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. The time's up. So basically what do you mean by the P to E? P to E is basically signifies the price to earnings ratio, right? Like how much you have paid and how much you earn. This is the ratio, price to earning ratio. Okay. So in that situation, that particular person, if he has invested the entire money in the one company, or you can say he has put all his eggs in the one single bucket, what will happen? Somehow the A is not performing well, he will be in the huge loss. Okay, but if he has diversified the investment, so maybe A didn't perform as expected, but B, C and D will do. Got it? This is a situation. All right, what we call as an diversification. Thereafter, what we have the education and the awareness. It's a risk mitigation strategies. Remember, financial institutions should focus on educating the retail investors about the risk associated with stock market investments and the importance of diversification and the risk management strategies. Okay, this can help investors make informed decisions and avoid the excessive risk taking. So basically what happened, if we talk about the retail investments, or you can say if we talk about the share market or the stock market, it is a general situation. Okay, like mostly people who participated in it may not have proper knowledge of the share market. Okay, this is a very you can say genuine and the normal condition. Like maybe they're not having a proper knowledge of the share market, they're just saying that if a price of particular share is increasing, it means that the particular share is profitable, so just invest in it. All right, maybe the share was overvalued. Okay, maybe some other reasons could be there. So if anything in the you can say in the adverse direction happen, then what will happen? There will be a condition of losses. Okay, so to prevent this kind of situation, what the financial institutions try, that they must educating the retail investors about the risk associated with the stock market investments. Okay, like just not only see all the golden things. Okay, what you are seeing, you can say it's not possible that what you are saying it's the right direction, right? Maybe you are seeing that the price of the shares going high, but as I've told you, there may be a situation of the overvalued and all the things. So first is risk association studies. Second is the importance of the diversification and the risk management strategies. Help investors make informed decisions and avoid the excessive risk taking. Conclusion, if we talk about the conclusion, the stock market's strong performance coupled with indicators such as increased demat accounts and the high PE ratio present a risk to the retail exposures. Like whenever the prices are going high, remember whenever there is a infusion of liquidity here signifies the monetary value. So whenever there is a infusion of the liquidity, what will happen? The people will get the money. People will get the money, they start demanding. When the demand starts, the price starts. When the price starts, the company's valuation grows up. Okay, and when the company's valuation grows up, basically the shares valuation also grows up, but not in the terms of performance. It's just a monetary value is going up, or that's what we call is an overvalued, or you can say is a bubble situation. Or bubbling situation. All right, so maybe the share market is showing some growth and all the things, but it's not necessary that these things are associated with the stock valuation, but maybe with the increased demat accounts, high PE ratios and risk to the retail exposures. Okay, to address this risk, integrated supervision and the rigorous stress test on the retail portfolios are recommended. Okay, additionally, investors should diversify their portfolios and focus on the education and the awareness to mitigate the impact of the stock market volatility. Got it? Now, after finishing the stock market and the infrastructure and the capital risk, another type of risk category we have is the interconnected lending and the governance challenges in the bank. Now, here is a word I'm seeing here is the interconnected lending. We had seen this word before also. So where, now two questions are, where we had seen this term. First question. Second is, what is the meaning of this term? Okay, so there are two questions, where we had seen this term and what is the meaning of this term. And for this you having 20 seconds to think and answer, and your time starts now. 1 2 3 4 5 6 7 8 9 10 11 12 13th 14th 15th 16th 17th 18th 19th 20th. The time's up. So basically we had seen this term in the first question. First answer, we had seen this term in which area? We had seen this term in the pre-independence era, or we also called it first generation banking. Got it? In the first generation banking, we had discussed this issue, and in the pre-independence era, that was classified interconnected lending. Okay, second question was, if we talk about the interconnected, so basically in detail form I had told you in the previous lecture. Right now I'm just going to give you an overview. Suppose this is in 5 banks, A, B, C, D and E. All right, so there are chances that these banks are providing the credit facilities to each other. Okay, However, it was advised to get the credit from the Reserve Bank of India and the authorized agencies, but somehow there might be some mutual understandings and all. So this creates a financial web. Got it? So this is the condition. Now, if we move ahead, there is an overview. Interconnected lending refers to the practice where banks lend to each other or to related entities, creating a web of financial relationships. Got it? This practice can lead to a contagion effect where the default of one institution spreads to other, posing systematic risk to the financial system. Coupled with lax governance norms, this can amplify the challenges faced by the banking sector. Alright, now basically it's a condition. Like you can say, first is this practice can lead to a contagion effect where the default of one institution spread to others, posing systematic risk to the financial systems. Why? Because if we go by the picture, okay, so these all are interconnected to each other, right? So if you look at this picture, this is a financial web. Got it? First thing. Second, because this is the interconnectedness, or you can say interconnected channels, so this is the condition of defaulting. Like suppose if anything happens to A, so in this particular web, B, D and C, you can say B, D, C, E or C, these all are also connected with the A. So it means if anything's happened to A, will have the impact on other bodies also. Okay, and this will create a condition of uncontrollable market instability. Uncontrollable market instability. Got it? Why? Because here you are not aware about like what to do. This is a complete web. Okay, in order to, you can say, simplify it, you required a time, and as long as the time you take, the more damage will cause to the economy. Okay, so this is the systematic risk. Coupled with lax governance norms, this can amplify the challenges faced by the banking sector. Now, there is one thing. Governance norms are basically regulations and rules, and you can say rules and regulations. Okay, like we had just seen that the interconnected lending is dangerous for the banking system. Okay, thereafter we had seen that this must be protected. So in order to protect, it means that you have to restrict this thing. Okay, but to restrict these things, you required a proper rules and regulations on which you will govern the anti-interconnected practices. Okay, until or unless the rules and regulations haven't been designed and provided, nothing could be controlled. Okay, so this is the thing. Now let's move forward. First is the contagion risk. Now you can see here, first is the contagion risk. This possibility of default becoming a contagion is a significant challenge in the banking sector. If one institution defaults on its obligation, it could lead to a chain reaction of defaults among interconnected institutions, potentially causing widespread financial instability. Okay, like we had seen, suppose you can say this is a supreme authority, RBI. I'm just designing a diagram for you. Okay, so that you could understand and learn it better. All right, A, B, C, D, E. A, B, C, D, E. Okay, if this is a condition that whether the E has defaulted, okay, sorry, B has defaulted or E has defaulted, so it means that still the rest three, A, C and E, will continue their function as it is. First situation. But if we talk about the situation in which A, B, C, D and A, okay, all of these are basically forms a web like this. Okay, so if suppose one of them has defaulted, so because all of them are interconnected in a web, so this will be a cycle chain reaction. Okay, and other ones means B, C, D and E, they will also suffer a default. Okay, now you could see by yourself in this situation the things could be controlled, because right now we know that whom to target and how to make them stable. But in this situation, when the all of them are involved in the default, or you can say these all are the interconnected in such a way that this is a contagion risk. Okay, because it's a chain reaction of default one after another. In this situation, at least there are three institutions which are working well, but in this situation all of the institutes are being affected by the default virus. Okay, so this is the contagion risk, and how it's work I have told you. Thereafter, lax governance norms. Lax governance norms such as the inadequate risk management practices, lack of transparency and the ineffective board oversight can exacerbate the risk associated with the interconnected lending. It means that governance norms must be designed in, you can say, in accordance to ensure that there must be adequate risk management practices. It means there must be not a situation of blind spot. Okay, it means that the bank and the management is doing whatever they want to do. They're not thinking about what could be happen to them and how the things could be changed in a drastic way. All right, thereafter, lack of transparency. Remember I had told you the RBI, is the authority which having the right and the regulations to control the banking structure. All right, but how could the RBI states that whether the particular bank is doing well or not? How? By seeing the data and available records. Okay, so data and records availability is the thing by which the RBI could conclude that whether the bank is doing well or not. Okay, so if the data and the records are not transparent, or you can say are deceived, they are deceived, then what do you think? Is it possible to check out whether the bank is doing well or not? Basically, no. So transparency must be ensured. Ineffective board oversight, which means like every particular organization or bank is basically controlled by the board of directors. Okay, these are basically the policy makers. Okay, and all the managers and other officers are basically the executors who will execute the policy. All right, so basically whatever will be done with the management, how the things could be done, what could be the you can say potential things and all of these things must be generated through the first channel. Okay, because the first channel, you can say, is liable to provide the policy and strategy. Policy and the strategy. Okay, so if the policy is not provided by the board of directors in an you can say effective manner, similarly the executors, the executors will not be able to execute it in an effective manner. Okay, so the things will be done in an ineffective manner. Got it? So that's why board oversight is must required. Got it? Poor governance can lead to the risky lending practices and inadequate capital buffers, increasing the likelihood of defaults. Okay, like if the things haven't been clearly and strictly defined. There are two things: clearly and strictly defined. Okay, clearly means like all of the things, like what to do, how to do, when to do, okay, how to handle situations. All these kind of things have been defined in a clear way, so that easily could be interpreted. Second is the strictly. It means that consequences must be defined in a proper manner. Like if someone does not obey the rules, and if the some organization does not obeying the rules, like what could be the consequences. Okay, so if the things are clearly defined, it means that this will be a good governance. Good governance. All right, but in the reverse manner, if the things are not being clearly defined, okay, if the consequences are not clearly mentioned, might be there are chances that the governance could be mishandled. Okay, to address the challenges posed by the interconnected lending and the risk lax governance norms, banks need to implement the focused risk monitoring practices. Okay, and these practices includes identifying and monitoring the interconnected lending relationships to assess the potential contingent risk. Okay, like whenever the bank is you can say conducting a relationship with another bank or the financial institution like A, B, C, D, E, whenever they are doing this kind of things, the first thing is to identify and then monitor, like whether this particular relationship is possessing any potential contingent risk or not. It is called the self examination. If anything looks suspicious, or you can say threatening, same should be taken up for the consideration with the immediate effect. Okay, thereafter implementing the robust risk management frameworks to identify, assess and mitigate risk associated with interconnected lending. Okay, enhancing the governance practices to ensure the transparency, accountability and effective oversight of the lending activities, because until or unless the data and the records provided by the banks and maintained by the banks are not authenticated, or you can say unauthenticated, thereafter the things could not be done in a proper manner. Okay, so students, basically in this lecture we had finished till the focused risk monitoring. Okay, in the next lecture, we will continue from here. Till then, just revise all the facts and figures we have discussed in this lecture. Be ready for the another lecture. With this note, let's end this lecture, and what we say thank you.